Hello, Pankaj sir, Nupur sir, are you guys there?
Yeah, we are there.
Yeah, I
Yeah,
can hear
I'm there.
you. Nupur sir, તમારું બી એકવાર just voice check માટે.
Yeah, it's proper. The voice is
It's
proper.
proper.
I'm also
Everyone can
able to
hear.
hear you guys.
Done,
Yeah.
done. Perfect. Okay, I'm going on mute.
Hello, everyone. We'll just start in next 3-4 minutes.
Hi. Good evening, Pankaj.
Good evening.
Shall we begin, Pankaj? Because a lot of people have already logged in. So should we keep them waiting?
Yeah. So we just start.
Sure.
Yeah. Hello, everyone, and thank you all for joining today on a Saturday. Firstly, I would like to wish everyone a very happy new year. So, talking about the market, last calendar year 2025, was a very challenging year for Indian equity market. In fact, it was one of the worst performing market in the world, where Nifty Sensex gave a return of around 4 to 5% dollar return and around 9% rupee return. So now everyone wants to know what is stored for us for the this calendar year 2026 and beyond. So to address that today, we have Mr. Nupur Patel, who's a veteran in the financial market, having more than 22 years of experience. He's heading our asset management division. He's associated with PL Capital now for more than 10 years, and he's the best person to talk about the market. So now I'll hand it over to Nupur. So if you have any questions, please put it on the chat box. We'll take it after the presentation. So Nupur, over to you.
Yeah. Thank you, Pankaj, for giving us an opportunity and welcome. Wish you a very, very happy new year and good morning to everyone. And we're really thankful that you guys have attended probably early morning. That we really, really appreciate that. Obviously, it's been good start of the year for everyone out there in US because probably we just got a very good news that your credit card interest has been kept to 10%. That's the first thing of the savings that can translate into economical growth. We have seen a lot of actions, as Pankaj has rightly put forward in last 1 year, not only with respect to the equity market, but during the precious metals. And we have also seen some sort of geopolitical, which has just emerged in last 15 days. Having said that, there has been long standing issues related to Israel, Russia, and many countries as well. So yeah, it has been challenging year. But challenge is a time when you get good opportunities, you can really build your portfolios. Obviously, as a PL group, we have been in financial services for more than 8 decades. We are led by strong research house. We always believe that equity market returns are never linear. You will always have a years where you will have an opportunity to buy the right sector stocks, and challenging time only helps us to understand that where man versus boys, how they do, where the maturity plays more important role and the experience plays out. So as a house, we have been pretty candid in terms of our approach. Our quantitative models, we had suggested somewhere around August 2024 that we see challenging times coming forward. We've been proven right in our multi-asset models. We increased the allocation to gold maybe around a year back to as high as 30+%, and for the interim period, it was as high as 40% as well. So obviously, our calls on asset allocation, our call on increasing weightage to the precious metals has played pretty well for us. How, Pankaj, you want the today's webinar to, you want to ask some questions, you want me to take them through the presentations, or probably if you have some thing that you would like audience to know and we curate that way, I'm open for whatever format that you want today's call to be navigated.
I would say we'll start with the presentation and then we can take the question.
So let me just share some data points with you all to understand. As Pankaj, is my screen visible to everyone?
Yes, yes.
Sure. So as Pankaj said, if you see probably the India performance vis-a-vis to the global market, which is very, very important in last maybe year and a half, and then probably that's where the actual thing would play into the picture. So if you see in last 12 months, uh, just let me set my screen for my betterment. Yeah. If you see in last 12 months, India has been one of the worst market in terms of the performance, and this is an absolute performance. So if I add dollar per depreciation of rupee to that, you'll see that this bar would further shrink down. So Indian market in absolute term from Jan to December, the Nifty is up close to around 10%. But if I'll add it to the dollar, it will be not more than 6.5, 7% kind of return. So we have seen subpar returns in Indian market versus other global equities. And the primary reason, as we all know, has been the tariffs and a lot of uncertainties. And at the same time, India was coming from a very strong base of 21, 22, where we have seen one way up move in Indian market from 22 onwards till 24 mid. And probably Indian market has nearly tripled during this period. So yes, there has been challenges. The Indian market has not delivered, and that's the reason why we believe that next 1 year is going to be one of the best years in terms of the returns that the India can look, or probably the Indian markets can look forward. Every one of us wants to know that what the precious metal is stored in, because that has been a stellar performance for last year, year and a half. So if you see across various commodities, definitely the precious metal stands out. But even industrials, coppers, and all have done better in last 12 years. Crude is the only asset class which has been subpar. We believe that it's a good time that crude can see good upside in next year, year and a half. Obviously, with the recent development that has happened to the Venezuela, we need to see how it will play in next 1 or 2 quarters. But having said that, the gold and silver has done far better. I'll touch base during my conversation that what we see for gold and silver probably in next 12 to 18 months, and how we see these returns in gold and silver can play out. In terms of problem that India has been facing is a consistent outflow from the foreign investors. If we see, there has been a very strong internal supply of money. Mutual fund industries has been very robust. The DII has been consistently putting money for last more than 2 years. But when I look at the FIIs, and when we see the outflows of the FIIs has not been so bullish with Indian market. And let me rephrase other way, maybe around 1.5, 2 years back, when we had seen the consistent outflow from the FIIs. And if you will go back and see the any television channel, then everybody you were of the belief that India domestic SIP growth is pretty strong. Mutual funds are getting a lot of inflows. So FIIs will be forced to come back at the higher valuations. But when I see this at end of 1 year or maybe 1.5 year, I believe that FII has been one of the strong, smartest investors, because not only in terms of the absolute return, but they have seen the currency returns as well. So when they were withdrawing money at between 82 to 84 rupees a dollar, our understanding was that they'll have to come back at much higher valuations of the market, or probably Nifty. Last 1 year, market has not gone anywhere, and they have made probably 7-8% return just on the currencies. So yes, their timings were right. They were proven right when they were withdrawing. When you see this chart in September 24, December 24, when they were very aggressive in terms of moving out of Indian market, and they were consistently seller on month basis. These guys have actually done a pretty smart job. With rupee being at 91, they are clear beneficial or the beneficiary of taking money out of India. But Indian market, let me just put one phrase that how emerging markets have done. I'll come back to this slide later on. Yeah, this is where the India were actually facing the problem. If you see from Jan to December, out of top 1,000 companies by market cap, only 60% of the stock actually from Jan to December closed in red. And there were very few sectors which actually gave a stellar performance, like metals or maybe PSU banks. Otherwise, if you see most of the sectors, the returns were not even in the single digit, and there were sectors like IT, reality, or maybe for that matter, media, they were down in absolute term in last 12 months by more than 15 to 20%. And majority of sectors have been subpar. Average Nifty return, if I see the long-term average Nifty return of around 14-15%, majority of sector in last 12 years have been below the average return of the markets. So that is one of the most important things, that why the markets were sluggish. Most of the sectors had not able to participate or not able to generate the kind of returns for the investors. That was the key reason that why the India markets were underperformer compared to most of the other market. When we look at the indices kind of thing, high beta indices have done better. But when we look at the equal weight indices, or when we look at typically small and micro cap, where majority of the direct equity exposures has been, those indices have not even given a single digit kind of returns. So yes, India had its own challenges. There has been some sort of underperformance for Indian market in last 1.5 years. But with all these things put together, coming forward, say in next 2 quarters, you will see sharp recovery. Okay, so generally what leads to the growth in capital market? There are two key factors which leads to the growth in any capital market. First is liquidity. When we see the strong liquidity, probably the returns or the earnings don't matter. It's the liquidity which drives the market. Probably in 2021, majority of the global markets were beneficial because of the large liquidity that was pumped into the capital markets. But liquidity is always a short-term phenomena. Liquidity cannot have a sustainable long run in the market, because there are the pockets or the periods when liquidities would dry up or slow down. When liquidity slows down, the market finds its challenges to continue. It's an underlying earnings which are very, very important. If you have a strong earning growth, then the markets will remain robust. For nearly last multiple quarters, we have seen the degrowth in terms of the earning. We have seen downgrades happening, and there were no sufficient earning that was compensating the growth in the market. Now the earnings are likely to come back. If you see the preview, the quarterly preview that most of the brokerage houses has just released for this current quarter, that is December ending quarter, October, November, and December quarter, there has been a lot of upgrades happening. We see the strong buoyancy coming in. And there are multiple factors why we see this earning coming up. So probably Q3 and Q4 will be one of the strongest quarters that one can see. Probably Q3 and Q4 will see the earning revivals. And when liquidity along with the earning comes back to the market, that is when we see the sharp up move coming into the market. So there will be a lot of re-rating happening that we believe internally. We don't see major downgrade coming up for at least Q3 as a quarter, and probably Q4 will be much better than Q3 also. The demands will be sustainable. The markets are likely to do much better. In terms of the sectors where we believe, one sector where we've always been bullish and most of our portfolios were replicating, that was metals. More than last 3 quarters, that's 9 months plus, we had a substantial allocation to metals. We believe that metals are in their multi-year bull cycle. We had a lot of stocks within the metals across sectors, and within the sectors majority. So we had Tata Steel, Vedanta, JSW, SAIL, GMDC, and many more. And they have made very good returns for our clients. The second within the financials, the second heavy weightage that we had was the financials. The financials were also the mixed bag of selected NBFCs and public sector bank. And if you see, both these sectors have done very, very well. So our early call, based on our quant model, in somewhere around first few months of the calendar year, that was around February, March, where we went heavy, and they have played very well for our market. What we had avoided was IT. We avoided the healthcare, but now we believe that IT is placed pretty well. It's a price to perfect kind of sectors. yeah, there are going to be challenges. We need to see that what kind of visa restrictions or the newer policies that will play out for the IT sectors. But the downside for IT is very, very limited. Some orders will start flowing in from US. This quarter will be one of the most challenging quarters where we'll be able to see. But structurally, our strong belief is that it's one sector where you can have a contrarian view with next 12 months in mind, because it's been year and a half that this sector has not gone anywhere. Most of the leading stocks within the sectors are available at more than 1.5 years previous valuations, and they are here to give you very good upside. So IT is one sector where we believe that good upside can come, and one can keep their eyes on this particular sector. Probably coming to an absolute terms of just one second. Macro part of the economy. If you will see, these are the dates that we have put in terms of inflation is absolutely under control. We don't see any problem from that matter. Probably crude has been benign, which is very beneficial for India kind of emerging market. India is one of the strongest growing economy when it comes to the GDP. If you see, our GDP growth has been consistent in north of 7.5%. That is very, very important. At the same time, we have seen a 40 basis points growth in GDP. The GST collection has been very robust. Whenever you see the tax collection and a strong and the robust tax collection, you will always see the growth in economy coming back. And most important is SIP flows. SIP has been very, very consistent. Obviously, the underlying driver of strong liquidity driven. And one of the key reasons for the strong SIP in India is the transformation towards the financial assets. FD is now no longer investment opportunities, because net of inflation, FD is not generating the kind of return in fixed deposit that investors look for. Real estate has been very, very expansive in last 1.5 years. We have seen a phenomenal growth in real estate, and the rental yields, the residential and rental yields are also not lucrative enough to look at the real estate as an investment. So obviously the left alone asset, and gold has become too expensive, as we all know. So obviously the asset class which has been equity. So we have seen a consistent, and to my surprise, the inflows in equity SIP has been consistent despite of subpar returns for more than 1 year from the equity market. This shows the maturity of investor. This shows the stickiness of the kind of inflows that we see. And with some sort of robustness in SIP, we see that the India, see in any business, when you have 30, 40,000 crore flowing in consistently on month basis, that provides a strong base in terms of the growth for probably markets. So now I'll take a pause. Pankaj, if you have any questions that you want like people to know, or they want to know something, or if you want them to know about the strategies, you may ask.
Nupur, if you can just give an overview of different strategy, briefly what you have in PMS.
Sure. So we manage money in two forms for our investors: a quantitative models and quantamental models. And I'll give you the differentiation of both. PL as a house since 2019, it's been now 7+ years. We have developed an internal strong architecture towards very robust quantitative models. In a developed market, as you all are aware, more than 40-45% of assets are managed by passive funds. ETF plays very large role in developed market like India, US and Europe. We have seen a very strong. Just one second, I just need to take this call. Just one second. Hello. So we have seen a very robust flow in terms of so in US market, as you all know, more than 45% of assets are managed by ETFs or the passive funds. Prior to 1990, more than 95% of assets in US was managed by active asset manager. Now, if we see today, more than 45% of assets are with the passive funds. Close to around 35% of assets are with quantitative funds. And as you all are aware that there are multiple quant funds in US, and the active asset managers have shrunk to 15%. So in India, realizing the growth of the quant funds in 2019, we pivoted towards quantitative models. My multi-asset model, which had an allocation to gold, is managed by our internal quant models. And we also have a pure play equity strategy known as Aqua. Aqua is also managed by quantitative firms. So we have two strategies. One is multi-asset, second is Aqua. Both these strategies are managed by our internal quantitative models, which we have developed and back tested for more than 20 years. At the same time, we also have quantamental strategies. What do quantamental strategies stands for? The entire screening, filtration, processes, and selections are done by our quant models. Then there are investment committees and the fund managers who would decide an active call to the stocks or the sectors. So under my quant model in multi-asset and Aqua, there is zero human interference in form of sector selection or a stock selection. Whatever investment within the sector or the stocks are done purely by our models, and there is no interference from either an asset manager or an investment committee. Their job is to just refine the model. Their job is to regularly evaluate that what kind of sectors and the stocks that model has, work on models, work on rule, improvisation of the rules. Whereas in quantamental models, the selection of the stock is pure active play of an asset managers or an investment committee as well. So these are the two differentiation products that we managed under our house. One is quant, second is quantamental.
Okay. So in the quantamental, what are the different strategies what we have?
Okay. So currently we managed our money in quantamental in two format, discretionary and non-discretionary. Under discretionary model, probably the entire investment decisions are done by a group of experts. It is led by my colleague Sandeep Nima. Sandeep comes with more than 30 plus years of experience. He started his career in the sell side. His first buy side job was with JM Asset Management, where he spent 7 years. He was managing multiple equity strategies. Then he was with one of the largest global quantamental fund known as GMO, taking care of various geographies and the market, where his profile was to allocate money across various emerging markets as well as developed markets. He was managing 5+ countries. And he has a strong fundamental overlay. So the quantamental funds first is non-discretionary PMS, where we curate the portfolio based on the customer need. We curate the portfolio based on the need of an investor. If investor needs real long-term investment, if investor needs concentrated sectorial call, the way they want the investments are done. A consent of investor is mandatory before any trade under my non-discretionary PMS. So we curate the portfolio how they want. We take the investment decision, then there are joint consents, and whenever there is any change in the portfolio, we give our rationale, we give our understanding, and based on the acceptance by an investor, the trade happens. We have forthcoming strategies under discretionary play. One is LEAP. LEAP is my long, large cap buy and hold kind of strategy. The LEAP strategy would invest in only the large cap companies in India. It will have no allocation to small and mid cap. The purpose of LEAP is to be in the best sectors and the best stock. It will have a nifty outperformance kind of strategy. Second is Atom. Atom is pure mid cap and small and micro cap strategy. India is an emerging market, Pankaj, where probably the small businesses will generate better alpha. And you would always have a pockets where small and micro cap or certain mid cap companies will transfer from mid to large. So if an investors are looking for an extraordinary return, want to bet on Indian market on a growth story, then the Atom is one of the best strategy which will give you a combination where we don't invest in top 250 companies by market. It will start from 250 to probably 1,000 company under cap. So it would have a mid cap and a small cap as our universe, aggressive in nature because it has small and micro cap as investment. And as a house, we believe it's an appropriate time because in last 1.5 year, this space has not generated return for market. Even on the benchmark or even on the stock, majority of the stocks within this space is available at 15-20% cheaper than 1 year backward valuations. And at the same time, businesses are also doing good. And we have a strong recovery. We expect a strong recovery in economy. Then these sectors will do better. So with outlook going forward, we believe that Atom is very good strategy. And the third one is Trinity. What does Trinity strategy stands for is that it's a combination, it's a flexi cap strategy, or you can call it as a multi-cap strategy, where the allocation within the large, mid, and small varies. So Trinity would have 33% fixed allocation to large and mid cap, 33% fixed allocation to small caps, and balance 33% will vary between large, mid, and small based on our assessment where we want. So in a uncertain market, the mid cap, that volatile 33% would move more towards mid cap, or extreme volatility would go towards large cap. In a risk on phase, it will go completely towards small cap. That's how the rotation. So these are the strategies that we managed under our fundamental fund, where stocks would have an aggressive call. So in Aqua, in my quant fund, I don't take more than 4% exposure to single stock. Whereas in my fundamental fund, based on the fund manager conviction, based on investment committee conviction, I can go as 7%, 8% in a single stock as well. So there the investments can be more concentrated, can be more aggressive also in nature, because the whole idea is to have bottoms up. Quant funds would have a top down approach. So there the investment philosophy is that take the call on sector, take the call on the style. Underlying stocks doesn't matter. What it matters is which sector will make money, which style of investing. So the portfolio should be more of value oriented, growth oriented, momentum oriented, or combination of low vol and quality, combination of growth or value, combination of value or low volatility. That's how the structure is, where we do not focus on single stock. Our idea is that the strategy should make money. Our idea is that the processes should make money, and every company within the portfolio should participate. So we look at granular returns in Aqua. Aqua has been in existence for now more than 2.5 years, with north of 24% kind of returns, annualized basis, net of expenses that we have generated for investors. So investors who are expecting 20 to 22% kind of net of expense return annualized, Aqua makes more sense for them. MADP is in existence for now more than 4 years. These two are pure quant play strategies with zero human interference in selection of sectors or asset classes. If investors were to believe that they want a diversified allocation to equity also, to gold also, and other asset classes, then it makes more sense for them to look at my multi-asset product. Obviously, because of the gold allocation, which I've said been north of 30%, currently also have 27% allocation in multi-asset. Last 2 years have been extremely good with 17% return. But since inception, CAGR is around 15.5%. So with 12-14% kind of bracket return expectations, with 50% lesser volatility to the Nifty or a capital market, this is an appropriate product. Whereas fundamental will fit the investors who wants bottoms up approach, who wants the fund manager to pick up the right stocks, who wants the fund manager to bet on right sectors, and where the stock picking skill makes more relevance, then you can go to my fundamental strategy. So these are the two differentiated offerings, Pankaj.
Okay. So if you have any question, please post it on the chat so we can take that. So one more question which investor have is like, what is that, like, where one should invest, large, mid, or small cap in today's scenario? What's your view on that?
Okay. So probably we feel, Pankaj, for a shorter period, if you take a call for a quarter or two, then yes, definitely large cap is space to be because of a lot of uncertainty. Earnings are yet to revive. But when you take probably 18 months view or a 36 months view, or even for that matter, 24 months view, we believe that the best value will or best money will be made in small and mid cap space because of two reasons. One, Indian economy is coming from a strong recovery phase. We will see a very good recovery coming. Probably by December, the expectation is that India would be the third largest economy globally and will take over Japan. If that is the case, then obviously the small and mid cap is a space to be in from 2018 to 24 months and upwards kind of expectations. But if you look at next 1 or 2 quarters, because of the uncertainty, the large cap is a space where one needs to park money in. But obviously, when we come to the equity market, every one of us has 36 plus months kind of view. If that is a view for 3 plus years, then I would personally suggest that please start looking at small and mid cap. It will have a near-term challenges for sure, but it will definitely make phenomenal wealth for investors in next 2 plus years to come.
Right. So seeing the volatility in the market, you feel this is a good time to be in equity, or one should be in a staggered way? How it is?
Okay, so we have seen a lot of years, Pankaj, in past also where Indian markets have seen this kind of volatility. But what need to see is underlying growth. Today, economy growing at 7% annualized. There is nothing wrong that can go with listed companies or listed businesses. Majority of businesses are having phenomenal growth rate. They are very mature in terms. So India for next 10 years will be one of the best market in terms of an absolute returns when it will come to the equities because of our underlying growth, because of the strong appetite that Indian investor also has. See, you have also been in market for now more than 20 plus years. Just look at our own history. When we started our career, what was an SIP flow and what is an SIP flow today, and what kind of robustness that what we are seeing. So yes, I am very bullish with equity as an asset class. I see that next 10 years, India will definitely have one of the best. Actually, we are seeing the transformation change, Pankaj, from real estate, gold to a financial asset. So that kind of chain that we all are seeing, and the financial assets will become one of the major investment class in every household's portfolio. So when you will see today also probably our investment to GDP or maybe the household investment going towards equity market is pretty less compared to majority of the market. So when this transformation was to happen, obviously the markets will remain very robust. Markets will have very good growth coming up. So I am a strong believer that next 10 years, one of the best market to look in terms of the investments will definitely be Indian market. In fact, I have a contrarian view on currency because majority of your investor today is overseas investors. Last 30 years, we have seen the strong growth of dollar. Every one of us seen probably entire world moving from majority of currency towards gold, dollar. And dollar has been one of the strongest currency and the kind of growth that what we have seen in dollar and robustness in the dollar. Next 15 to 20 years, now cycles have shortened. So I'm just trying to shrink that 30 years can happen in 15 years or max 20 years. You will see decoupling from the dollar, and that has already started. Majority to see the reason why we have seen the rally in the gold. Obviously, one of the major reason is the uncertainty across the globe. But even the decoupling from dollar, we have seen a lot of central banks have started parking their surplus in precious metals. This is one of the most important aspect. So for NRIs, I believe that India will be a very good market, not only from an absolute return perspective, but even a currency return perspective. Maybe in next 15, 20 years, likely to see that maybe rupee can come in range of below 80. We can touch even somewhere around 78, 75 kind of numbers as well. Earlier, this used to happen, it took 30 years. But now as all central bankers are moving away from dollar, central bankers are parking in different asset classes. They are not looking at dollar-denominated investments any longer. That is where even Indian INR will strengthen. In a shorter period, because of all this uncertainty that we are seeing, there is a possibility that in a shorter run, we may see 95 kind of levels. But in a real long term, when you will look at 15 years down the line, I'm sure that you'll see sub 80 kind of valuations. And even in current, probably in May, probably current Fed chairman terms is about to end, and there have been strong news and rumors, obviously, that he'll definitely be replaced. Then there will be a lot of need for interest rate to come down. So even the benign interest rate is always positive for equities. And Trump is an advocate of more than 1% interest rate cut for 2026. So with that keeping in mind, I see that benign interest rate will also be beneficial to equity as an asset class.
Yeah, one question from the participant. What do you expect US dollar rupee to be in December 2026? Any view on that?
Short-term views are very difficult to take, Pankaj. I've given my long-term view for next 10 to 15 years because, see, I'll tell you, short-term views are basis of multiple reasons. One, geopolitical tension, crude prices, probably decoupling or buying into various asset classes. So in immediate term, we may not see, at least for a very immediate term, I don't see some need that dollar will weaken. But I am of a strong believer that the last 30 years was for dollar. Next 15 years, I see that INR will definitely will become much stronger compared to dollar. So we'll be above 18 next 15 years, sorry, below 18 next 15 years. The chances are more. The probabilities are very high. I see at least 85 to 90% probability of that happening in next at least 15 years.
One more question from the participant. What's your view on gold, silver? Silver has given 100% plus return. Gold has given 75% return. Still, one can invest.
I'll open the gold and silver chart also. Now you need to see the reason that why these precious metals are moving up. Gold definitely, as I've touched upon, for two reasons. One, geopolitical tension, which we are seeing of late, it has even escalated more. Second is decoupling from the dollar. And this will happen. This will consistently happen. Obviously, when any asset class, let me just share that return chart for every one of you so you'll get a better idea to that. For any asset class, when you see appreciation, see, this is probably the asset class returns that will give you a better clear-cut picture. Maybe silver has appreciated more than 150% in last 12 months. Gold has appreciated for more than 65% in last 12 months. Obviously, any asset class, be it equity, gold, silver, crude, you name it, or maybe industrial metals as well. When you see this stellar kind of performance, they need to take pause. But there are two reasons, fundamental reasons for gold also and as well as for silver. Decoupling from dollar by central bankers will continue to happen. This will not stop. So there will be an inherent demand for gold at a regular interval. So gold can give some intermediate correction, yes, because obviously 60-65% growth in 12 months, it can. But in a long run, gold can further rally, yes. By end of 5 years, by end of 3 years, if you see gold much above the current valuation, answer is yes. Second, silver. Silver has not only appreciated because of the differentiation that they had, but silver has also appreciated because of the industrial demand. Today, most of the maybe automobile industry, solar industry, wires, cables industries, they have started using silver. So silver doesn't only have intrinsic value, but it also has an industrial value. So silver will definitely see much more appreciation. But having said that, with one underlying caveat that, see, these are the kind of return. In 6 months, it's 100%, 30%. So when rally is too sharp, it pauses. It's the nature of any asset class. When asset class sees a sharp rally, there will be some sort of pause that you will see to the asset class. Then it will consolidate because that happened even with Indian market, right? 22 to 24, we saw Nifty one way going up. Then earnings didn't compensate it with the growth of market. So earnings to come back, the market took a pause. So what is market? Market is P, price to earning. If the stock price moves up, earning has to catch up with the stock price. If earning can't catch up, then price will go through either the market will go through the price correction or a time correction. That is what we are witnessing in Indian capital market. So similar can happen with the precious metals, but it will be a very good case scenario at every deep or at sharper deep. One can definitely accumulate because next 3 to 5 years will be very strong. And the storage by central banker in precious metal will continue, and that will definitely, and that story I see for next 10 years, not for a shorter term period.
If dollar is weak, won't export be affected?
But exporters have been benefited tremendously in last 1 year, right? And importers has been butchered. So some point of time, you need to have balance between two. You just cannot, and it was even in the interest of Indian economy growth to let the rupee go way it was going. But as it is a sanction, we'll have zero limited exports left. So, but that's secondary. But they'll find their way. India has its own robust. See, India, trust me, Indian company has a very strong internal demand by itself. India is one of the fastest growing population, one of the youngest earning population. So India own consumption itself is sufficient enough for corporates to grow. So next few years, we see a strong demand coming on from our local people itself, and that will be very, very important to look at.
So one question everyone has in mind, what one can expect as an investor in next 3 years return-wise? It's difficult to say, but approx?
I see our strategy at least 5% alpha to the benchmark consistently. Benchmark Nifty return I see will be in range of around 14 to 15% if you see average in next 3 years. We are very bullish in the current scenario. With the earnings revival, our understanding is that probably markets from here can see or can give you a very sharp 10 to 12% up move on underlying benchmark. Our 6 to 9 months target on Nifty is in north of 27,500 around so. So we see good 1,500 upside, or maybe if you see in percentage term, maybe around 7-8% upside from here. So it will definitely remain very robust. We will see a very strong growth coming in, which would be strongly supported by underlying companies' earning growth. And you'll see this quarter. Just wait for this quarter number, which will start in next week itself. You'll see upgrades coming in, and upgrades will be very sharp. But what people would also look at the commentary for 27. Most of the analyst community wants to see that the robust demand that has come because of the GST rate cut, because of 12 lakhs of income being subsidized from the tax, will this continue? So what outlook that corporate house has, and if even 70% of the corporates are confident enough of being the same outlook for 27, then markets are headed for a real bull run.
One more question from the participant. Gold and silver buying are done in dollars. How come dollar demand will come down?
I see decoupling happening, sir. Just wait for some time. It's too early and immature for me to say that. But we would see globally decoupling happening. So exactly the dollar, which was the key currency for last 30 years for crude, for precious metals, will automatically get decoupled. It's a time that will play out. See, no economy would have that perpetual. Obviously, every one of you on the call, your entire earnings are in dollar. So, but having said that, it's an economy cycle which will turn back. We had seen excellent dollar returns for last 30 years. You will see in next, because now cycles have shortened. What used to happen in 5 years now happens in 1.5, 2 years. Because of this shortened cycle, I see the strong 15, 20 years that reversal happening. It's very immature to say right now because we will not believe it. But just let times pass by, and you will see that happening across the globe.
Okay. What are your top sectorial themes for the next 12 to 24 months?
We are constructively bullish in financials. We'll continue to remain bullish in financials for sure. We have two contrarian bet where we see the major money will be made with the medium to long term view. One is IT. As I've already been touch base, I see that the worst for IT is over. Sector has not gone anywhere for last 18 plus months. And this quarter can see some surprises coming from an IT sector. So IT can be one very good sector to look at. Majority of mutual funds are either neutral or equal weight or slightly underweight in IT, so that can go an overweight. That will give a leg up. Second is oil and gas sector. We believe that oil and gas sector can be one very good sector where stocks like HPCL, ONGC, BPCL can be part of everyone's portfolio. So IT and oil and gas are two contrarian underlying sector where we are bullish. We will continue and we are continue to remain bullish for now more than a year and so on metals and financials. And we see that they will definitely be part of our portfolios. They will not completely move out of our portfolios. So structurally, we are bullish on metals and financials, and they have played very important role in our portfolios. So if I were to say sectors, the four sectors look good to me: IT, oil and gas, metals, and financials.
Okay. So here over here, majority of our participants are NRI. So you can just elaborate on dollar funds what we have?
Okay. So we operate one investment fund outside India jurisdictions based out of Mauritius. This fund is an inbound fund for overseas investors. So any client or an investor who doesn't want India compliances, that means you don't want to find tax in India, you don't want botheration of short-term, long-term capital gain tax, you just want to stay invested for perpetually long-term. Then we have one fund which is a feeder fund. It's a category 1 FPI. Your investments will happen in dollar. Our fund will bring that money in India. Taxes will be paid by the fund. The currency fluctuation gets adjusted in the NAV. So as an investor, your entire returns are published in dollar. You will get the return in dollar denomination, and you will get redemptions also in a dollar denomination. So with an investor who doesn't want India related compliances and doesn't want to bet much, then this is one of the best investments that one can look at, which is your dollar fund. Entire onboardings. Okay, so you don't need to be even see in India. If you want to do onboarding, then your physical presence in India is required, or your last 6 months visit to India. This fund doesn't have any restrictions. So if you want investments to remain in dollar, investments to happen in dollar and redeem in dollar, then this fund makes more sense for you guys.
Okay. Well, I think we have covered all most of the questions. Now, one like major trigger is budget. Like any view, like it will be pro or like how it is.
So earlier, maybe around 3 or 5 years back, budget was one very big event, and all financial decisions were taken during budget. But if you see the pattern of the current government in last 2 years or 3 years, they don't wait for budget. Whenever there's a need of an appropriate time, they have taken the right kind of decisions, irrespective of budget or not budget. And GST was classic example of that. So I see budget non-eventful because last budget we already saw the tax cut happening. That was a booster. Corporate tax has not gone anywhere. So this budget, according to me, will be non-eventful. And trust me, last 5 years budget has actually been non-eventful. So I don't see any fireworks coming from budget because they've already been. You have now 12 lakhs plus income has been subsidized. GST cut just came last festive season. Then what more can you expect from government? And government balance sheet also should have a more to offer, right? So I don't see any major fireworks happening in budget. Budget will be just one speech or a statement that will come out. Yes, projections on economy to see. debt to GDP ratios are some things. So macroeconomy data is what we will look at in budget. Otherwise, from announcement perspective, I don't see that government has much leeway, anything were to happen. So it will be just one statement that one needs to look at in the fine print to going forward. Defense can be one sector where we can see some sort of positive announcements coming in budget, not much apart from that.
Great. So thank you very much,
I
Nupur,
would
for a
like to touch
very,
base one more
yeah,
thing, Pankaj, which we just missed out. See, if you are an investor who wants a secured fixed return, doesn't want a market volatility, but yet want an India kind of exposure, then we do have one AIF, which is a performing credit. So for investors looking for a fixed return, a zero equity market kind of risk, because there we don't invest in stocks. We lend money to corporates, listed and unlisted. It will give you around 14 to 16% fixed returns. The tenure of the fund is 5 years. Maturity of underlying assets are only 3 years. PL understanding the need of performing credit fund and understanding the quality of paper has to be pristine. We have an independent investment committee comprises of 6 industry veterans. We have ex-chairperson of SBI, Mr. Rajnish Kumar on the board. We have a corporate practicing head of ENY on our board. We have probably one of the best audit firm, Kimji Kuverji and Company owner on the firm. At the same time, investment director of Blackstone is also on our board, and chairperson of PL Asset Management and a PL Group, Amisha Vora, is also on the board. So there are veterans who's a binding investment committee. So investment manager or a sponsorer cannot lend money until and unless approved by this investment committee. So that's one of the very important de-risking kind of thing. It's a regular coupon fund. So every drawdown would have 9 to 11% quarterly payouts. The fund targeted IRR are 14 to 16%, and very mature kind of investments that one can expect from this particular fund. A robust fund, consistent in terms of the maturity. The sectorial cap is 25%. So we will not lend more than 25% to a single sector. We will not give more than 10% to single stock. This is not a stock, but I would say company. So with an investor profile of 14-16% return expectation in India, if you have money in NRO or even in NRE, you want to park money, you can definitely consider this fund. As I said, my expectation that rupee will strengthen in next 5+ years, then this will make more sense. Your absolute return will improve much better because of the currency gain adding it to it. You can definitely consider fund, which is a non-equity fund and a fixed income kind of product that it would offer to you. So I wanted to just touch base, Pankaj, that fund as well.
sure, sure. So you would you like to talk about that first close? How much we have raised?
We did 100 crore in the first close. Fund is now open for a subscription. Drawdowns for an investor would happen 12 to 18 months. So I will not take entire money in one go. As and when we identify the opportunity approved by the investment committee, based on the investment size, the drawdowns will happen from an investors. So the first close has already happened with 100 crore. We are likely to deploy that money soon. We'll try and see that we do the first deployment in the current financial year itself. But having said that, opportunity also has to come to us. But with that in mind, our understanding is that probably investor with 14-16% net IRR return in hand can definitely consider this kind of fund, and it is open for subscription. Anyone can come and subscribe to this fund because the first drawdown has not happened as yet.
So it's open for NRIs.
Yeah, it's open for NRI, it's open, and in my dollar fund and AIF for NRIs, the onboarding is completely digital. So there are no physical documents that are required.
So I think we have covered all the questions. So thanks a lot, Nupur, for a very informative session. Any closing remark for the investor from your side?
I will personally suggest that look at India as an investment destination. You will definitely make a lot of money because Indian markets, compared to all global markets, has not generated any kind of return. In fact, Indian market has been one of the most underperforming market in terms of the dollar in last year and a half. Obviously, the mean reversal is on the card. India will give you one of the best returns in all aspect. I had shown that chart also that how India has done in last 12 plus months, where probably Indian return has been lowest and in dollar term has been further lower. So it's an appropriate time because see earnings, underlying liquidity is very strong in India. Nothing to worry with 30 plus thousand crore coming by SIP every month, lump sum investments, then strong inflow by HNIs, family offices. It's pretty robust. But underlying earning will also revival to the growth. So India will surprise most of the investors. Please consider your parking majority of investors. If you were to ask me personally, more than your 30-35% of financial assets with 10 years of investment horizon should definitely be in India. And that will give you one of the best returns because India has political stability. India has strong businesses and any economy where you have the largest earning population will definitely lead to the growth as well.
Okay, great, Nupur. Thanks a lot. Thank you. Thank you everyone for joining. Yeah.
Thanks everyone. Have a great weekend. We are open if you need any kind of one-on-one call with Pankaj and me to deep dive more on the strategies. I've not gone in much detail because I thought that we will just touch base overall about market economy and everything. But if you all want to understand any strategy in detail, you can reach out to Pankaj and his team. We will be happy to take one-on-one call with every investor at any time that you all need.
Thank you.
Thank you, guys. Thank you.
Thanks, Nupur. Thank you.
Thank you.